Greetings and welcome to the May 2025 Investment Strategy Brief. In this session, I want to get into the idea that policy uncertainty, the tensions around that, and the uncertainty around that are persisting. Of course, that's affecting the economy and the market. So let's jump into it. To start and take a look back at the kinds of changes we've been seeing in D.C. We know that there's a big wave of new tariffs and changes in trade policy and a bit of volatility, if you will, in that policy. There's actually a tax bill, a reconciliation bill making its way through Congress. We've had the efforts of the Department of Government Efficiency, or DOGE, and then big changes in Health and Human Services, immigration policy and border security, and the Department of Education, and elsewhere as well. But it's been kind of jarring to folks. And in fact, it brings into focus, as we've discussed before, that back when we looked and developed our outlook for 2025, we also framed up two other scenarios to our base case: a bear case scenario, which is more negative, and then a bull case. And on the bear case side, in some ways, it's felt like it's been playing out. So erratic shifts in policy, poor communication about that, creating worries and what we would call sort of an erosion of animal spirits that affects in a negative way the economy and the markets. Now, folks have been nervous about a recession. They've been particularly nervous with the trade tensions that recession could turn global. And if you couple that with the potential for still firm or higher inflation, you end up in an environment, recession plus high inflation, that's called stagflation, which generally doesn't happen, and what it does is quite negative. So again, you can see by the probabilities on the right that we're not overly worried about any of these in terms of causing major trouble, but of course, we're seeing some evidence of it and some patterns that we keep an eye on. Now, we're very fortunate to have Brian Gardner. This is Stifel's chief Washington policy strategist. He's been writing and talking actually a lot about tariffs and trade and the current reconciliation bill that's making its way through Congress. And I'd say the upshot right now is an acknowledgement that there remains quite a lot of uncertainty, yet against this sort of backdrop where we could see things like the extended tax cuts or even more tax cuts. And in fact, that leads us in a way to our bull case scenario, which we think is much lower likelihood of coming to fruition. But think of it as an environment where ultimately businesses celebrate the idea of greater deregulation, the idea of lower taxes, that spurs more business activity, M&A activity kicks up. We see increased manufacturing onshore. We see lower energy costs in general. And the investment in infrastructure, especially around artificial intelligence, all that coupled with the potential for greater efficiency in the government, those were sort of the anchors to what we thought of as a bull case scenario. And some of those things are showing themselves too. But again, at this point, the negative side of things is sort of winning out to a good degree. So let's turn to the economy. In fact, focus in on one piece of data that sort of illustrates that. This line shows that we had a shutdown for the pandemic, things recovered, we got back to trend growth. But if you look to the far right of that line, there's a little dip down. That's the first quarter, first estimate of GDP. And basically that number was negative 0.3%, I think. And yet it had two factors that were influenced by the tariffs in it. One was a huge increase, an influx of imports, which is a headwind to GDP. And basically that was explained as people getting ahead of tariffs. If we're going to import things and tariffs are coming, let's import them more quickly. And then on the flip side, businesses, for the same reason, worries about tariffs, built up inventories, which is a positive to the economy. Those two things netted out slightly negative. And then importantly, the consumer, who comprises about 2/3 of the economy, actually grew at an annualized rate of 1.8% in the first quarter. So that anchor core component of GDP actually remained pretty positive. And when we look at other data like retail sales, for example, things are sort of bumping along, but a little bit above the long-term average. So positive numbers, generally speaking. And that's against a backdrop, by the way, of increasing cost of debt for consumers and sentiment being down, both sentiment and what's called confidence down, all in an environment where actually the labor market is held up pretty well. So on the business side, by the way, when we look at confidence, there's a couple indices that we track, one for small businesses, another for larger firm CEOs. And the punchline is there was some optimism that sort of unfolded as the election happened. And we've come back down to about neutral level, maybe slightly below neutral. So again, that shaking of animal spirits, the uncertainty of policy causing people to slow down and not be as optimistic as originally happened when the election actually occurred. So all this translates anyway to really economists across the street, including our own Dr. Lindsay Piegza here at Stifel, basically lowering their forecasts. So we started the year with a consensus view as growth at 2.1%, a very healthy number. That overall has come down to 1.4%. So think of it as more modest but positive growth, with most folks not expecting a recession in 2025. So again, still reasonable, but not as good as was originally thought. And, as it relates to Lindsay, Dr. Piegza, she's just such a terrific colleague. And we highlight in this session and the corresponding report that we produce, essentially a special report that she had done on the ports, the U.S. ports, where the data is showing indeed a slowdown, likely as people are pausing as it relates to the worries about tariffs. And so certainly if you get the slides to this session in the show notes here, you can click on that link and check out Lindsay's good work. Now, coming back to the environment and the economy, we've seen worry about inflation. So for example, the one-year break-even rate, that's the bond market telling us what investors think inflation is going to be over the next year. Basically, the number's 3%, right? The Fed has a target of 2%. Investors are thinking 3%. Individuals, even looking out longer, the consumer survey type data is well above 4%. And yet when we dig into some of these indices, what we see is that actually Republicans are pretty positive, thinking inflation is going to cool to 2, but Democrats are really worried, thinking inflation could go above 5. And so all that's around a look forward. When we actually look at the data as it's being sort of delivered, actually over the last 3 months, both the consumer price index and the producer price index have produced numbers that average a level well below the Fed's 2% target. And even the last specific prints, the CPI was right around that level, and the PPI was actually negative, down 0.5%. And so again, the data right now is showing inflation cooling, but there's a significant worry among businesses, consumers, and actually the Fed that these tariff troubles will reignite inflation to a degree. All that translates to, though, with the worries around uncertainty and kind of the worries from the Fed that we could see inflation pop back up. Basically, the market is now projecting 2 quarter-point cuts in the Fed funds rate between now and year-end, whereas we looked at this data in the last session a month ago, it was basically 4. And so all of a sudden, people are suggesting, hey, maybe fewer Fed cuts going forward. And of course, that's important in the sense that what it does tease out is this idea that the Fed needs to try to balance its dual mandate. So stable prices, meaning controlled inflation, coupled, though, with trying to maximize employment. So we're in this interesting environment where inflation's coming down, employment's pretty good, and there's worry about inflation going higher given tariffs. And so the Fed's sort of in a position where they can keep this tight monetary policy in place a little bit longer to try to keep inflation in a good spot, especially, and push back on any headwinds that would cause inflation to go a little bit higher. And so, again, we'll see how things pan out for them. We know that this is all against a backdrop with these higher Fed funds rate. The market rates have been higher. That translates to higher costs of debt across the economy, households and companies for sure, but most importantly, in a way, the Treasury, meaning federal government, having now $36 trillion in debt. The debt, when we count interest as part of the discretionary budget, the interest costs are about 1/3 of the discretionary budget. And, the punchline here is that people are very focused and very concerned about the fiscal trajectory. So we're hearing that from various corporate leaders and government leaders. And it remains the case that we believe that the idea of sort of reducing the deficit and reducing spending is something that's going to happen here in the U.S. By the way, there was a downgrade in this last month by Moody's of government debt from AAA level to basically AA1. Now, honestly, this comes after many years ago, Standard & Poor's reducing the credit level to AA plus, kind of the equivalent level on their scale, and the same thing for Fitch, bringing things down to AA plus. So Moody's, in a way, was sort of the third company to do this, but it does bring back into focus the idea that there's concern around the deficit, there's concern around the debt, and the cost of debt service relative to our overall budget. And so, I've been telling clients when it comes to this level of credit rating, it's still a very high quality credit. So people aren't standing around worried about the U.S. defaulting on their debt, but the lower the credit quality, the higher the yield. So this is one of the forces that's bringing up an upward pressure on interest rates. So the 10-year now at around numbers around 4.5%, and actually the 30-year up above 5%. And so, just think of it as this pressure for interest rates to be higher, and that translates to a higher cost of debt as people move, companies refinance debt or build out more debt, or the government has to refinance. The cost of our debt is going up with these higher levels of interest rates. Now, turning to the markets, this elevated yield environment, which we've talked about, is certainly well above where we were during the pandemic, for example. But when it comes to investing, that means various categories of fixed income are showing very appealing yields looking forward. And then turning to equities, let's update ourselves on this first year of the presidential cycle. So recall that this blue line is the average going back quite a long time of that first year. It's usually a positive year in the first year of a presidential term. And then the orangish line is President Trump's first term. The gray line is what we've experienced so far here in 2025. So the big drop, especially related to Liberation Day and the announcements of tariffs, and then some relief when the tariffs were paused. And then as deals are being cut and so forth, we can see some recovery. So we're back to a point where we're almost at even year to date. And recently seen some volatility. But again, this is something that we're all watching very, very closely, of course. Now, to give us a sense for how bad it's been in terms of current levels, the level that the market's at about now, it was sort of a record at this level back in October of last year. So I always tell people, hey, think about how you felt back, in this case, in October. People would say, I felt pretty good. And so, yeah, we've seen some volatility, but markets have held up reasonably well. Now, as it comes to valuation, because of this recovery, we see the cap-weighted index being a little bit overvalued. We see the equal weighted index being a little bit undervalued. And then importantly, when we unpack the first quarter earnings, basically we're seeing a year-over-year growth rate estimated to be 13.5%, which was just better than folks were expecting. So think of it as companies holding up and doing pretty well in terms of the earnings that they've been posting, which is, again, a positive effect on the markets. All this translates to, again, being about even on a year-to-date basis. The equal weighted index doing a little bit better over that period. That's the broadening of the market that we've talked about. And I also threw in this time around a one-year number, the last year. So think of it as from today looking back a year. And what this tells us is there's segments of the market that have performed quite well. And so the market, again, overall has been holding up reasonably well given the volatility. This is, again, against an environment where the dollar's weakened a little bit, but still within a range that it's existed in for the last few years. And I did include, again, a couple charts that remind us that volatility is normal. So here's a chart that talks about the 5% or more down moves happening a couple times a year, the 10%, that market correction type move happening about every year and a half on average, and then to jump to the 20%, that's the bear market move about every 6 years. And so, again, the kind of experience that we've had isn't that unusual. And again, recovery is something to keep in mind. And here's a chart that we like to look at showing calendar year returns going back to the start of this century. About 2/3 or so of them end up being positive for the full year. But in every single year, there's a part of that year where the market turns negative and it goes negative. And so what we see is that happen and then recovery and often a positive return, right? So again, we're back to about even after our biggest sort of peak to trough move this year being down 19%. So this kind of volatility is normal. Here's another chart, basically unpacking every time the S&P 500 declined 15% or more, going back a number of years. And then essentially the green bars, the red bars are the decline. The green bars are the subsequent 12-month recovery. And then the numbers next to it is how many months it took for the losses to be earned back, right? And so sometimes it takes a while, but there are some of these moves where the decline happens and then it's single-digit months before the market's back to where we've been. So we're in a period now where we're not sure where it's going to land, but we'll keep an eye on that and update the chart when appropriate. So those are a few charts that just remind us that for long-term investors, it's really wise, to be diversified, and we think sort of focus on that extensively in the current environment, the market broadening out. But for long-term equity investors, it's ideal to sort of stay the course because these periods of recovery can happen quickly, and it's really hard to time getting back in if you've jumped out of the market. Anyway, looking forward, just reiterate that we do keep a focus on our long-term themes, fourth industrial revolution around tech innovation, things like artificial intelligence, strategic resources and how they're being secured, how demographic changes are affecting things, how new consumption and new consumer practices are affecting things, and then productive competition. In some way these days really focuses a lot on U.S.-China and how we're sort of battling with them for sort of economic dominance going forward. As ever, we'll invite everyone to check out stiefelinsights.com for this and other parts of our work. Thank you so much for spending time on this session, and we look forward to seeing you next month. Thanks so much.